Good Monday morning, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, high AI hopes. Nvidia earnings present another major test for the stock market this week. And it is M&A Monday. Keurig Dr. Pepper hopes a jolt of caffeine can boost its struggling coffee business. Plus, here come more tariffs. Stocks like Wayfair and La-Z-Boy are on the move as President Trump targets furniture imports. Danny, what are you watching?
Well, I am watching Nvidia. You have to, right, Matt? It's the big test of the week. When they release earnings on Wednesday, shares a little bit weaker this morning. Expectations, they are high as traders look for some reason to remain bullish on AI. We could see large moves in big tech. 40% of Nvidia's revenue comes from other Mag 7 companies, Matt. So it is the risk of the week.
Yeah, definitely an important one to watch, the company to watch this week. This morning, though, Keurig Dr. Pepper has made an $18 billion move on Dutch coffee giant JDE Peet. This will create the second largest coffee company in the world behind Nestle. You can see that Keurig Dr. Pepper shares are down 8%. The more interesting thing, I think, is that it's going to split its business, Danny, into two. So the soft drinks and energy drinks on one side and the coffee on the other.
Well, let's start with just that. And for more on the deal, we are joined by Bloomberg Managing Editor for Global Business, Shelly Banjo. Shelly, 7 years after the two came together, why would they split after this acquisition?
Yeah, it's essentially an undoing of the deal. This is what they do. These deal makers pull things together, break things apart, and this is sort of the situation that we're in now, where you have an industry that has only really gotten growth by raising prices, and the unit sort of growth is sort of flatlined or not, is not growing as fast. And so what are they to do now? Let's split the business. Let's see if we can get more customers that way. They
have had amazing success with brands like Dr. Pepper, which is, I'm told, neck and neck with Pepsi now, only behind Coca-Cola. And they're building with this a huge coffee business. They already own Green Mountain and a number of other brands. They make coffee cups for Krispy Kreme, for McDonald's, for Newman's Own. But I think it's interesting that they're going to split, and at this point, I wonder which one will offer more revenue, because until now, the soda business has been much bigger than their coffee business.
Yeah, I mean, the soda business is doing much better. I mean, coffee is not a great business to be in right now. You've got huge increases on pricing, huge issues with supply, and a number of people that are moving away from some of these coffee brands. And so their Keurig Dr. Pepper, the Dr. Pepper part of the Keurig Dr. Pepper business is actually doing a lot better.
All right, it's a fascinating deal that we're going to continue to talk about. Looks like the coffee company will have $16 billion in revenue, and the soda side $11 billion. And as Shelly mentioned, the prices have been through the roof on the underlying asset in terms of coffee beans, right?
Yeah, and the good news is put it together, break it apart, the bankers get paid. So I'm sure
yeah, bankers get paid. All right, Shelly Banjo runs our company coverage here at Bloomberg. Let's get to the stock market's next big test. As Danny was pointing out, Nvidia earnings Wednesday after the bell. Investors are hoping the results will soothe fears about AI spending and concerns of a brewing tech bubble. Joining us is Bloomberg Tech co-host Caroline Hyde. And wait, was anyone worried about AI spending? Isn't it?
That's so last week.
Were there fears about AI spending?
I mean, Palantir down for a few days. I mean, Friday seems to have made all of our short-term memory just lose a little bit like that. But we did have anxiety and actual impact on retail exuberance around AI purchases of stocks related to it. And I wonder whether this will set the record straight in terms of getting retail back involved, whether we start to see Nvidia as the key bellwether, almost rivaling the importance of a Fed decision in many ways. Look, it is 3% of global market capitalization in the world. And so when you're thinking about that and the supply chain impacts and the companies that are related, this is going to have a big sentiment check for many. And actually sentiment is, even though we've seen a sell-off in the stocks, analysts have been getting into this stock of late. You're seeing only one sell rating, and in fact, nine analysts alone last week upgraded their price targets for the company. Many are really feeling positive about the amount of ramp that we've seen with the Blackwell in particular. It's going to dial back the China anxiety that we've seen weighing on the stock for a while.
Well, to that point, the chip story, tech story, and politics ever more entwined. We learned Friday after the bell that the U.S. government would be taking that just nearly 10% stake in Intel. They say it's passive, but this is a president who's called the CEO into the White House to talk with them. What does this future of Intel look like with DC having a 10% stake?
And Bloomberg Intelligence is trying to see the pros and the cons in terms of, like, look, there's no governance impact, but realistically, are you going to see a change in demand for Intel's products going forward? Has the government taking a stake taken away any anxiety? Look, this company could end up, pushing itself out of business because it wasn't innovating quickly enough. Could you see the demand, which ultimately Lip Bhutan, the CEO, was questioning in the previous earnings? And that's why he said, look, I'm not going to do a build it and they will come. I need to see real demand for my 14A processors for me to keep innovating and pushing along to keep up with rivals. Well, now does the government impact mean that, yes, you will get a Qualcomm and Apple and even an Nvidia looking for fabs to be made by Intel? Yes, you start to manufacture more in Ohio, but also you drive the innovation there and you make it a US success story. However, if you're a shareholder, are you diluted? And more broadly, does this just change the rules of the game in the way in which you think that Intel had been valued going forward? How much is there an anxiety about the way in which US government impact doesn't always be a fiduciary duty and doesn't always drive profitability?
Or a hope, right? Because President Trump is pretty good at persuading people to do things, right? SoftBank has come in with an additional $2 billion investment. I wonder who else could be supported by the government in this way. Kevin Hassett this morning said that the government may take stakes in other firms.
And it's whether or not you would ever see. They've already tried to push back that you wouldn't see it on a TSMC or a Samsung or a companies that have been persuaded to build it. Exactly, and they're the ones that actually they want to not have to rely on so much. You want to be able to rely on Intel as a US domestic manufacturer rather than TSMC. But what of Micron? What of other companies that have managed to show that they can innovate and they can spend their way to appease the government here in the United States to manufacture more? But who else and what other industry groups? I think this is wholly unprecedented. We are not in a time of war. We are not in a time of financial crisis. And yet still the national security impediment of global chip manufacturing and AI race, it makes it vindicated in some way with the US government.
Yeah, I thought Bernstein put it well, though. Yes, they can use the money, but they also need customers, to the point that you're making, Caroline. Thank you so much for joining us. That is Bloomberg Tech co-host Caroline Hyde. Now, we're also going to get a number of retail earnings this week. They include Gap, Kohl's, Dollar General, Best Buy, and Dick's. Bloomberg consumer editor Emily Cohen joins us now. Emily, we heard from the giant last week, Walmart, who was able to keep prices low, but talked about tariffs increasing their prices every single week. If we get some of these smaller ones, are they going to be as resilient as we heard from Walmart?
I think that's the key question here. I think we learned a few things last week. We learned that the big retailers that can afford to keep prices low, that can negotiate good deals with their suppliers, are doing so. Also, a lot of these stores imported a lot of these goods before the tariffs went into effect. So what they saw in the last quarter is consumers are resilient. Also, where there are deals, shoppers will follow. So those are the kinds of themes that we're looking for this week. Are these retailers passing along the cost of tariffs yet, or is that still to come? And how are shoppers feeling? How are they doing? What are they gravitating towards? And those are the big questions.
Right, because the outlooks we get now are going to be all about back to school. For a lot of these companies, that's huge, right? Best Buy, for example. And the question isn't, I think, only are they going to pass along costs in terms of raised prices, but are they going to be offering discounts? Who's going to discount the most into September?
Yeah, and we heard from Walmart last week. They saw a strong back-to-school shopping season. Why? Probably because they had the best deals. So we'll be looking to see who else is touting those same wins or who else might have lost to other retailers.
Aren't you excited?
Yes.
Another week of sweet retail earnings? Emily Cohen runs our retail coverage for us here at Bloomberg News. Let's get a quick check on what's going on in terms of futures after rock and roll Friday, really. We were up more than 1.5 on the S&P 500, almost 2% on the Dow Jones Industrial Average. We added like 900 points.
Yeah, best day since May.
On the Dow on Friday. Now futures are down a little bit, but you can understand maybe a little bit of profit taking there. Also, maybe a bit of a reality check in terms of what's going on with the jobs market versus inflation.
Yeah, but we are 0.1% away from all-time highs. Kind of a bummer not to get there today and to see a little bit of
Well, you never know what happens throughout the day.
That is true. Yeah. We certainly could get a turnaround. This not helping, though, coming up on the show. Furniture stocks are plunging. The Trump administration investigating imports as part of its tariff regime. So we'll have that for you next. You're watching Bloomberg Open Interest.
Let's get now to high interest. Look what's making headlines around the world. The buyout firm Thoma Bravo will buy the call center software maker Verint Systems for $1.23 billion in cash. That's a 10% premium for the company. Thoma Bravo plans to combine it with another portfolio company that provides workplace management software. The deal is expected to close by the end of the year. And Vornado Realty Trust will buy an office condominium above Saks Fifth Avenue's flagship department store here in New York City for $218 million. Vornado expects to close the purchase of that property next month. By the way, it's 75% vacant right now. Furniture stocks are on the move in the pre-market after President Trump announced a tariff investigation on furniture coming into the U.S. That's hitting companies like Restoration Hardware and Wayfair that import a lot of their products. Furniture manufacturers with a large U.S. footprint like La-Z-Boy and Ethan Allen are having a different reaction, obviously gaining because they will have less price competition, Danny.
Yeah, definitely. Everyone's going to have La-Z-Boys. That's the future. For more on the impact on Wayfair in particular, as you showed, Matt, plunging in the pre-market trade, we're joined by Bloomberg Intelligence e-commerce analyst Poonam Goyal. I'm looking at FA screen on the Bloomberg terminal, Poonam, and it looks like about just under 40% of Wayfair's suppliers are located outside of the United States. Just how painful would a furniture-specific sectoral tariff be for Wayfair?
It would be painful because prices will have to go up. Now, you have to remember for Wayfair, they don't own inventory, right? They're a marketplace. So it's the sellers that have to deal with the higher costs, and they will have to figure out a way to either absorb them or pass them on to the consumer. The issue arises when you pass them on to the consumer. Will the consumer pay more? Will the consumer have the appetite to spend more on furniture? So that's the key question, is demand could perhaps take a hit if prices do rise. But as for Wayfair, because they are a marketplace, they're not directly impacted, but more indirectly impacted.
So how much cheaper is it to buy furniture made outside of the United States, import it and sell it to Americans, rather than making it here in industry that I think once did really well, or at least had a great reputation, but was very expensive?
Yeah, I think, look, furniture is one item that can be made here. You know, when we talk about apparel, we don't think you can move apparel manufacturing here, but furniture, we do have large furniture hubs in North Carolina and throughout the US. That said, it's not about how much could be made here. It's about at what price can you sell it here. So Wayfair, for example, sells furniture that's significantly cheaper than an Ethan Allen, for example. And part of that is due to the fact that it comes from outside of the US. So if we were to make it here, prices would rise.
Poonam, though, are the Wayfairs, Amazon.coms of the world at a disadvantage because they are asset light? Yes, in normal times that benefits them, but other furniture companies, you've seen them be able to front run tariffs, really build up inventories. So does that leave Wayfair and, again, Amazon behind their competition who were able to do that?
Yeah, I think it's a catch-22 because remember, by being a marketplace, you're not limited to that one supplier, that one seller. There are millions of sellers that you can target, and hopefully between them, you can toggle with who can have the best prices to offer, offering similar merchandise on your platform. And the one thing about being a marketplace is that consumers, it's not like buying milk, right? If the price of milk goes up, the consumer notices. But if you launch a new product, the consumer doesn't have a place to compare. How much was this before? So when you bring fashion into the mix, there is some price acceptance when it goes up through quality or just through a change in design.
What are the ballpark figures that you're hearing in terms of tariffs? I mean, how much does the U.S. want to extract from this industry?
I don't know the answer to that. I think your guess is as good as mine. We know there's a 20% tariff on Vietnam. China's higher. So, for this to be alarming, it probably needs to go above that 20% threshold because we're already there in most countries. But we haven't heard any numbers just yet.
So we don't know what it will be yet, and consumers are probably seeing this and also unsure. What kind of pull forward effect could we have then?
I think think there will be some pull forward. I think there has been pull forward all year, quite honestly, which is why retail sales to some extent have held up so strong through the first half of the year. That said, there are deals. Like, when I go onto Wayfair right now, the Labor Day deals, they're pretty aggressive. So for an industry that's worried about prices going up on furniture, they're still offering quite significant deals to get the consumer to shop. And we do think the consumer has an appetite to still shop right now.
All right, Poonam, thank you so much for joining us this morning. Bloomberg Intelligence's Poonam Goyal on Wayfair stock sinking. One stock that's rallying in the pre-market is Intel. Matt, this just out from President Trump on Truth Social saying, I paid zero for Intel. It is worth approximately $11 billion. All of that goes to the USA, going on to say, I love seeing their stock price go up. It begs the question is if Intel is giving away this for zero, what are they getting in return? They say it's going to be a passive stake, but just how passive would you likely see the government?
Yeah, absolutely. I mean, he's already called for the resignation of the CEO. Yep. Then he had a meeting with the CEO at the White House. Now they're doing this deal. And of course, the U.S. is putting billions of dollars in the hands of Intel. So it's not zero. It's just that it comes from President Biden's CHIPS Act that President Trump is using. Very interesting stuff and really interesting discussions. Have been had around that all last week, and we'll continue all this week. Let's take a look at what's going on in futures, because we had a big rally on Friday and we're down this morning.
Yeah, it was the biggest rally since May for this equity market, and we take a breather this morning. We are down about 1/3% across the indices. Matt, as I mentioned, we are 0.1% away from an all-time high, a dovish injection from Powell that was surprising to many people, allowing this market to rally. At least it was on Friday, not necessarily today.
Yeah, absolutely. And we're still looking, though, at like 85, 86% chances of a rate cut in September. That's what that rally was all about. That hasn't changed much. Coming up, we're going to talk to Keith Lerner of Truist. He upgrades U.S. small caps, which had an absolutely massive rally. I think the Russell was up 3.9% on Friday. He joins the show next. This is Bloomberg Open Interest.
Truist upgrading U.S. small caps to neutral from less attractive. Co-CIO and Chief Market Strategist Keith Lerner cites valuations, improved earnings trends, and technical signals. Similarly, RBC Capital Markets notes that small caps tend to outperform larger stocks when economic growth is below average. Truist Keith Lerner joins us now. Keith, how much of this is about fundamentals versus Friday getting dovish injection from Jay Powell?
Yeah, well, Danny, great to be with you and Matt. It's a combination of many factors. We follow a weighted the evidence approach, and we already saw before Friday things started to change. So the first condition is we know they've underperformed by a lot. Look at the last 3 years on a rolling basis to large caps. They've underperformed the S&P 600 by about, by about 40%. So you have a condition of being oversold. Valuations have been cheap. That hasn't mattered. But what's been different over the last few months, we're starting to see those earning trends, forward earning estimates move higher, and that's pretty broad-based. We can speak more about that. You throw on top of that the rate cut, which I think on the margin is positive, and also somewhat appreciated is the one big beautiful bill had some real cash incentives for tax rates for these higher leverage, more interest rate sensitive names as well. And then finally, the technicals. The underlying trends are positive on an absolute basis, and then on a relative basis, we saw a breakout on Friday. You put that all in the mix, at least on the margin, we would say you should be somewhat less negative. And even though we had a big Friday up move, if you zoom out a bit, they've still underperformed by a very wide margin the last few years.
So when we talk about the Russell 2000, for example, I always hear that only about half of them make money. I'm not sure if that's 60% or 40%, but in that ballpark, right? Where do you see the quality? Where do you see the money makers inside that index? Is it financials? Is it industrials? I mean, who's doing well?
Yeah, well, and you're right. And that's why I think longer term, we still like large cap, that secular technology theme in general. But on the margin, I think we have to acknowledge a shift in that way of the evidence. And we've kind of focused more on the S&P 600, which tends to have a earnings quality and a factor to it. But to your point, what's interesting, when we look below the surface, even though it's a lot less weight, small cap tech and communication services are seeing those earnings move up. But also the two biggest sectors within the index, financials and industrials are also moving high. I think on the financials, probably a beneficiary somewhat of a little bit of steeper curve. And let's not forget, we probably will have a bit more of a pickup in M&A, which should also be supportive for at least the trade in small caps.
Well, Keith, even just that, I mean, it's a small cap index that feels like it's been hollowed out by private capital, about small companies staying private for longer or even being taken private. There was another Thoma Bravo one just today. Is the quality of the small cap index, has it been declining?
Absolutely. And that's why we're looking at this more of a trade, because to your point, I mean, not only is private equity buying these companies are staying private, and when they come to the market, they're coming when they're bigger. And also your team over at Bloomberg did a great analysis with the Mag 7 and showed that they have purchased or had M&A or taken over these smaller companies by a clip of about 800 companies since they've come public. So you think about that. And then also with small caps, once they hit a threshold, they get moved up. So that's great. But, once you become a winner, you kind of cut those winners. So again, that's why longer term, we think secular growth in large caps makes sense. But on the margin, especially with how much outflows we've seen out of small caps, we think it makes sense for a little bit of catch up.
All right. Keith, stay with us. We have much more to discuss, including some of the large caps that you mentioned. Keith Lerner of Truist. A quick check on the markets this morning. Matt, we are unfortunately looking at small caps reversing some of the Friday gain, but as you pointed out, 3.9%. It has a while to go if it wants to reverse that.
Yeah, absolutely. I mean, it was killer, and I was just looking at the chart over the last year. The Russell, at least, is up. Since we started this program on July 8th, it's a pretty decent gain. So if you bought them then, you're doing well today. We're back with the opening bell next. This is Bloomberg Open Interest. Moments away from the start of trading on this Monday morning post-Jackson Hole. This is Bloomberg Open Interest. I'm Matt Miller. We saw big gains after Powell's speech at the Grand Teton, and now we're looking, giving a little bit of that up. The S&P was up, I think, 1.6% on Friday, down about 0.2%. This is just the futures, right? Down about a third on the Nasdaq, down about a third on the Russell. You hear the opening bells. We see at the New York Stock Exchange, Brillia ringing the bell. I'm not sure. It's a maker of women's intimate apparel, and it's like almost all dudes.
A lot of men there.
Like, what do they know about shapewear? Maybe a lot. It's the 90s, And there at the Nasdaq market site, you see Safex ringing the opening bell. They just went public via SPAC that had absolutely cratered, and it hasn't done great since then, but we wish them luck. In terms of stocks to watch, Danny, we have the big one reporting this week.
We do on Wednesday. It's going to be Nvidia. And Matt, this is the big risk. We've gotten through Powell. We got through Jackson Hole. So this is the next thing to earmark. It is unchanged, but expectations, they are high, now pushing higher. As traders look for reasons to remain bullish on AI, we could see large moves in big tech. 40% of Nvidia's revenue comes from other Mag 7 companies. And that sell-off we got in tech, Matt, the worst 5 days in some time before Friday, could mean that the pressure is that much higher for Wednesday.
Yeah, I think a really interesting story, although the shares aren't telling it right now, up 0.02%. Yep. We'll watch for movement throughout the day. The big story in terms of M&A is Keurig Dr Pepper. It's paying $18 billion to buy Dutch coffee giant JDE Peet. The company will then split into two. It'll create the second largest coffee company behind Nestle, and the other will have Dr Pepper and Ghost, which I'm told is popular in terms of energy drinks, 7-Up, and a number of other, Snapple, obviously.
What is Ghost?
Ghost is like an energy drink. The ones I know, because I'm old, are like Red Bull and Monster, right? But then the kids, like Shonali was always drinking Celsius.
Yeah.
And I guess Ghost is one of those competitors.
Okay, I mean, it's too bad it's not like Celsius where it had those magical ones that were actually high noons that they had to recall them for because they were mislabeled.
Yes. Do they have booze in them?
Yeah, and they had booze in them. Makes them all that much more exciting.
All right, so maybe Ghost could do that. Anyway, we're back with Truist CIO, Co-CIO, and Chief Market Strategist Keith Lerner. And Keith, we got through the small cap discussion, and we're done with that. Let's take a longer term, maybe more risk averse look at some of the large cap stocks. Danny just pointed out that I think 40% of Nvidia's revenue comes from Mag 7 companies. And it does seem like they're just all moving money around in between each other. How much actual cash CapEx is being spent?
Yeah, well, I mean, it's a great point. These companies, which have been asset light, are becoming somewhat asset heavier, at least. But the main thing, we're focused on is the earning trend. So we are, somewhat concerned about all that spending. But so far, when we look at the Mag 7, we're still seeing those earning trends move up, and they're moving up at a stronger pace relative to the overall market. And when you think more broadly about tech, what leads to outperformance? It's that. I mean, valuations have rebounded. Think about the technology sector was down to about a 21, 22 multiple at the lows. Now we're back up to 30. So those earnings have to come through. We're still overweight tech. We think they will come through. I do think, though, that road band for tech got stretched. We were up 50% in about 4 months. That's the most since 2000. So maybe a bit more of a chop here, but I think longer term, it's hard to bet against tech as long as those earning trends are moving higher, which they still are, and deserve the benefit of the doubt.
Keith, you started out by mentioning how these companies are becoming asset heavy. I think that's one of the most interesting turns. As the hyperscalers build out data centers, need energy to support their various operations in AI. Does that change how you look at a Microsoft, a Meta, a Google, what have you, and how you value them? Because the prospect of them being asset light used to be a huge beneficiary, and why you used to see and still do valuations so high.
Yeah, no, I guess if you said, hey, Keith, what's on the concern? You're still positive on tech. What's the concern? It's that. But when do we see that filter into the earnings number and start to see earning trends start to change? And just so far, we're not seeing signs of those earning trends. And we still think, as we think about the AI cycle, there's probably a pretty long tailwind for it as a whole. And then I also think about not just about tech. Well, in an environment where the macro uncertainty is still relatively large, what's a better area, which has better growth prospects? And it's hard to really identify something, better than tech at this point. So again, we'll stick with it, but we've been expecting a bit more of a chop long term, and we'll be looking at those CapEx versus earning trends in the next few quarters to see if anything changes. But so far, we haven't seen it.
Keith, if you're an investor that missed the AI leaders, and it's granted it's been a few years, so you really would have had to sleep through it. But how do you rebalance, especially when we're coming into earnings for Nvidia?
I think the one thing is you should zoom out a bit, right? I mean, I know we'll have all the attention on Nvidia the day before, the day after, but if you zoom out and think about, what is that earning profile going forward? Where are we in the AI cycle? I don't know that it'd make any real changes. We're still overweight this sector. I mean, if someone's gotten way stretched, you may kind of pull back a little bit, but it's an area of the market that I think we want to stick with. And then if you in the S&P 500 itself, with tech and tech plus, you're above 45% as a whole. So, at this point, we're not making a lot of shifts. We're just having people be realistic that it's often 2 steps forward, 1 step back, and we just can't go linear the whole time. Going back to even like Nvidia, look this year. The stock's up about 30%. The forward earning estimates are up about 25%. So a little bit of multiple expansion, but you are seeing that earnings are actually also moving at a good clip higher.
Keith, is it also possible to be bearish at all on risk as long as we have that pivot, the dovish pivot intact from Powell, as long as he's flagging downside risks to unemployment and opening the door to September? Is it possible to push back on a market after getting that?
Sure, and I don't, my big picture is, the rate cuts on the margin are positive, but it's not the main driver. I mean, think about the market this year. We're up double digits and the Fed hasn't cut. So you want to keep that door open, but I don't think it's the most important thing. I think those earnings are actually the most important. We just had a great earnings season just recently, and then we've surprised most of this year. I think to your point, though, the biggest risk to this market is expectations. We have the PCE report on Friday. The employment report after Labor Day is going to be also very important. And we know valuations are high and credit spreads are extremely tight. So that is the risk for the overall market. So I don't think at this time you get more bullish than you were over the last few months. But at this point, we think the trend deserves the benefit of the doubt. And if we get those pullbacks, well, at this point, we'd be playing it as opportunities. But again, I mean, it's not like everything is perfect.
Yeah, I got to say, Ed Yardeni would probably agree with what you just said, Keith, given he doesn't expect a rate cut, but thinks earnings will propel the market higher still. Keith, we're going to have to end it there. Thank you so much for joining us this morning. Truist Co-CIO and Chief Market Strategist Keith Lerner. Now, we are about 7 minutes into your trading day today, and we are moving decisively lower. What's bringing us there? It is tech. Man, a painful day for Palantir. Those shares down 4.3%. It is the biggest dragger on this S&P. But elsewhere, it's the Mag 7s. It is Apple, Microsoft, Nvidia, AMD. It is all a tech flavor that's in the biggest loser column. By the way, 338 stocks are down this morning, 161 to the upside. For some reason, Alphabet and Netflix are still rallying, so not all tech is doing poorly, but you will see in the sectors this morning, it is also tech that is one of the worst. If you look at the GRR screen on your Bloomberg terminal, Infotech down 1/3%. You do have 3 industries into the green this morning, and that's real estate, industrial, so a little bit of kind of a bond proxy flavor to what's going on. But Matt, it really just has the feeling after Friday's rally, the best day since May, this is simply a breather. It doesn't necessarily look like the bullish trend has been broken.
Yeah, not much of a dip really to buy, at least not yet. Obviously, things change throughout the trading day. When Romaine comes on at the close, it looks often a lot different than it does right now. Coming up, Nvidia down less than 1%, and it's weighing on the S&P still because it's a $4.3 trillion company. Nvidia expected to move more than 5% after earnings on Wednesday. We'll discuss how we know that and what that means with Mandeep Singh of Bloomberg Intelligence. This is Open Interest.
Let's get you some top calls, some of the analyst action to focus in on this morning. First up, American Eagle getting clipped, great pun, at Bank of America to a sell because of tariff pressures. Analysts there noting that the environment is so bearish that not even its Sydney Sweeney campaign will be able to lift the pressures. Can you imagine? Things are so dire that Sydney Sweeney can't save you. Next up, Alaska Air, that's getting upgraded at Raymond James. Analysts citing a positive demand trend and say that the stock is at an attractive level. Shares still off this morning, though. And finally, Lazard, they're getting an upgrade to buy at KBW. The analysts there highlighting that improved deal flow in the U.S. and Europe. Those shares up 2.33%.
All right, very cool stuff, upgrades and downgrades there. Let's get to the top story for the week. The pressure on Nvidia ahead of its earnings report Wednesday. Investors will be looking to the largest, I guess, company in the entire world and the biggest weighting on the S&P as well to soothe fears about AI spending. Here with more is Mandeep Singh, global head of tech research for Bloomberg Intelligence. And I keep questioning myself here. Are there really fears about AI spending? Doesn't it just go up, up, up?
It does, and it is a multi-year investment cycle. I guess what investors care about is the pace of estimate revisions, which is where Nvidia has done phenomenally well in the past, 8 or 10 quarters, every time they do a big beat and raise. And that's where, you have to ask yourself about the variables. GPT-5 did have a launch, Was that a little underwhelming? I think so. I mean, Meta is talking about using more cloud providers for their compute.
It was a lot underwhelming, by the way. As someone who uses ChatGPT all the time, it didn't change my life at all.
Exactly. And so that's where, estimate revisions are determined by how much do these large language model companies need in terms of compute 12 months from now, 24 months from now. And from that perspective, do you really need a 1 million GPU cluster 12 months from now? If GPT-5 was underwhelming, probably not. But at the same time, you still need a lot of compute for AI inferencing, which is where NVIDIA continues to see a lot of demand, and the market is still undersupplied. So I think when you're underwriting, 40 times earnings for a stock, you have to ask yourself what is baked into expectations and what can keep surprising to the upside. And that is where, if you take out H20 sales to China, if you take out, more compute needs, the scaling laws, then that's where probably I feel you will not see a big positive estimate revision with this print.
Well, to that point, Jensen Huang really caught in between both the U.S. and China with having to pay 15% of its revenue of H20s to China to the U.S. Reports are that China trying to prevent its companies even from buying H20 chips. How does Huang address this? Do you expect him to talk about the politics of the moment?
No, he's going to continue to, double down on the sovereign demand. So, the Saudi and the Middle East deals that he had signed, and that's where, being part of the administration did help Nvidia. But look, sovereign demand, I don't think will fully offset what China, I guess, currently makes, about 20% of revenue. And that's where you have to ask yourself, all the largest, LLM companies outside the US are in China. If they can train a model that is comparable and as good as the models here without using NVIDIA chips, does it lower the dependency, and what does it mean going forward? So from that perspective, not being able to sell S20s does have an impact on NVIDIA's future.
We said before the break in the tease that this could move the shares up or down 5%, the earnings report. I want to just show our viewers how we figured that out. On the Bloomberg terminal, you can type EE, and if you want, you can type EE space SURP, and it gives you really cool information, including here you can see what they've posted in the previous earnings report, and then the a percentage change in the share price. The implied move, one-day move after earnings is 5.82%. How seriously do you take this data, Mandeep?
I mean, if you're trading this stock, you take this data seriously. If you're a long-term investor, all you care about is the trajectory of estimate revisions, the fundamentals. And that's where, as I said, it is a multi-year investment cycle. It's just, is it going to compound at 20%? Or 30% or 10, 15%. And that will have a bearing on what multiple you put on the stock.
Just to go back to the politics, not to harp on it, but also on Friday, we learned that the U.S. would be taking a 10% stake in Intel. It's supposed to be passive, but could we get to a place where things like where NVIDIA chips are built, where other chip makers look, is going to increasingly be Intel, that you feel that pressure from the U.S. government?
Not yet. I think, right now they took a stake, and to my mind, it's a good thing for Intel, even though the existing shareholders did get diluted by 10%. But I think the positive is the administration really wants, the local chip manufacturing companies to be successful, and Intel is the biggest company. So from that perspective, I can imagine Intel probably getting some orders, not of the highest end, advanced node chips, but probably CPUs, they still have the largest market share. So they may not cede as much share to AMD as they were doing, in the last few quarters. So from that perspective, I do think it's a positive development.
All right, Mandeep, great to have you here, and we'll obviously be talking to you probably more about this tomorrow, and then on Wednesday, and then we'll bring you back Thursday morning for sure. Mandeep Singh runs our tech coverage for us at Bloomberg Intelligence. Coming up, Keurig Dr. Pepper gives its coffee business a boost. Details of the $18 billion deal to buy JDE Peet next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a look at what's going on with stocks on the day, the first trading day after Jackson Hole. We see drops compared to the gains we saw on Friday. S&P 500 trading, well, it's down, but still at 64.52. I think the all-time high is 64.68, so we're not that far off. The Nasdaq 100 down about 0.4%, losing a little bit more ground because Intel is off. Take a look here. Intel, okay, it's only off 0.25%, but it's a $4.3 trillion stock. It's the biggest weight on the S&P. I think it's worth 4% of all equities on planet Earth. So it's pretty big. Intel is now down 1/3%, even after news that President Trump and the United States government has got a 10% stake in Intel. Trump tweeted today that he paid $0 for an $11 billion company, but really he paid about $11 billion for it. Wayfair is down right now, as is Restoration Hardware, because the president is talking about furniture tariffs, and these guys import a lot of the stuff they sell from overseas. Verint Systems is off right now, and this is a company that just got bought by Thoma Bravo. So maybe we saw the premium last week. I'm not really sure, but it was a $1 billion deal. and it's now falling. And then Keurig Dr. Pepper is down as well. That makes a lot of sense because they paid $18 billion for JDE Peet, Stanny.
Yeah, by the way, on Varen, it was up 20% in the pre-market on rumors of the deal. The deal premium is barely different than where it closed on Friday, so maybe that's why you see some of the disappointment. But Matt, let's get more on Keurig Dr. Pepper, because the CEO there sees the acquisition that you were just talking about as an opportunity to, quote, create a global coffee giant. Joining us now is Kenneth Shea, Senior Consumer Products Analyst for Bloomberg Intelligence. Ken, so they're going to put the companies together and then break them apart between coffee and the beverage business. Why do it?
Yeah, hi, Danny. Well, essentially, I think from a Keurig Dr. Pepper shareholder point of view, what it does is address the current drag that the Keurig coffee business is placing on the company, quite frankly. This is a business that's being challenged right now, higher green coffee prices. You got tariffs coming in from Brazil, exacerbating that problem. Cool demand for, at-home brewing. All those things are conspiring to have kind of a subdued second half and maybe beyond for that business. So I think the company probably tried to, seek offers for it to sell it. They didn't say that. I don't know it. It makes reasonable sense. But what they're trying to do now is, instead of doing that and perhaps getting a low multiple doing it, they're teaming it up with JDE Peet's, which is basically the number 2 global brewer. And they're selling it as a, synergistic transaction that also helps it divest its Keurig business on a tax-free basis.
Coffee prices have been through the roof. I mean, we saw a little bit of a dip, but if we were to graph the price of a coffee bean, I think we'd be near an all-time high, and it looks like a hockey stick, the most recent rise. Is this the time to do this kind of consolidation?
I think it is. I think this coffee price increase has been an elongated one over the last few years. Granted, it's been somewhat volatile, but the trend is clearly going up. These compounded price increases for this category are much higher than most other categories for non-alcoholic beverages. And, there's some evidence to suggest that consumers of cold brew coffee, for instance, are moving away to energy drinks as their caffeine source. So things like that are occurring, and Keurig is very aware of it. And so it's taking action.
Yeah, Ken, I was going to say, neither Matt or me drink coffee. Apparently, everybody drinks matcha lattes right now. How quickly can Keurig and JDE Peet's adapt to quickly changing consumer in just less than a minute here, Ken?
It's going to create an opportunity for them JDP, to get into the U.S. and to bring some more innovation to the brewers, to the home brewing business. At the same time, it can leverage some of the know-how from KDP to their non-U.S. operations. So there really are some opportunities here for that entity. Having said that, I think the cold beverage side of KDP is really the crown jewel. Higher margins, faster growth.
Dr. Pepper, so delicious also. Ken, thanks so much for joining us. Ken Shea there of Bloomberg Intelligence. He covers this industry for us. Coming up in the next hour, Brooke May of Evans May Wealth on the market impact of Nvidia earnings. We'll talk to her about M&A as well. Then Nasdaq Chief Revenue Officer Jeff Thomas joins us to talk about IPOs. They've had the best first half since 2021, and we're going to talk alternative assets and retirement accounts with ICI CEO Eric Pan. We got a packed show for you, so stay tuned. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. We are 0.1% away from all-time highs, but weaker so far in this morning's trade. Coming up on the show, high AI hopes Nvidia earnings present another major test for the stock market this week.
It's M&A Monday. Keurig Dr. Pepper hopes a jolt of caffeine can boost its struggling coffee business.
And as the U.S. IPO market heats up, we'll discuss what's in the pipeline with the Nasdaq Global Head of Listings, Jeff Thomas.
All right, we begin with some economic data that is crossing the Bloomberg terminal right now. You can type EcoGo, or if you like, you can type WecoGo. Did you know that with a W? And then pick your flag. We're looking at new home sales right now that are better than the previous reading and better than the estimate. So 652,000 in an industry that many would describe as stuck. Over 627,000. That was the prior reading. That was actually revised up to 656,000, and 630 was the expectation. So it's all in the same ballpark, but it does seem to be doing a little bit better.
I will say the month-over-month figure did disappoint, falling 0.6%. The estimate was for 5.5%. This is, of course, a sector which the White House has talked about a lot and wants cuts from Jay Powell to bring back the housing market.
Yeah, I mean, the drop is because of the revision, right? So the revision was to the upside, though.
Okay.
And the question is, do you leave that statistician in his or her seat or fire that person?
Joy,
and replace?
that's the question we ask about all data now, I suppose.
The stocks that we're watching, well, the biggest stock that we're watching and the biggest stock in the world is Nvidia. It accounts for 3% of the world's total market capitalization. Shares are expected to move more than 5% in either direction after the report on Wednesday. Evans May, wealth managing partner Brooke May, joins us now. I'm giving the implied move. That doesn't mean it's going to happen. That's just based on what we've seen in the past. Brooke, but what do you think about Nvidia earnings? How important is this event?
They're massively important. As you alluded to, they have a significant weighting globally, but especially in the S&P 500. And Nvidia has a great history of beating on earnings expectations, but guidance is going to mean a lot. 58% of companies raised their guidance in Q2, and we expect the same out of Nvidia. If we don't get it, then we'll see some volatility in the market.
Brooke, what does that volatility look like? Because we've already had tech stocks falling. Before Friday, they had fallen for 5 consecutive days. How vulnerable or resilient is this market to a bad print from Nvidia?
I think that it could lead to some volatility to the tune of 5% or 3%. Who knows? It depends on how bad guidance would be, which isn't necessarily our base case, but it could be a catalyst to create some volatility. When we look at Nvidia, they're the leadership. We think that we're in a mega trend for technology, and Nvidia is leading the way. That said, a lot of tech companies are signaling to be overbought, and we wouldn't be surprised if we see a modest sell-off if Nvidia disappoints.
This company, though, has just grown so quickly in the Mag 7 or Mag 8, if you want to include Broadcom, has just taken so much of the concentration of the S&P 500. How are you advising your clients in this kind of in this kind of situation to rebalance? I mean, do you just set it and forget it once a year? Do you have to rebalance every quarter? How does it work?
We make tactical shifts. For example, we added gold earlier in the year. It's based on the current environment and the data that we're getting. But we make tweaks. We don't get in and out of the market. We do believe, though, that we are in a mega trend for technology. So we like the overweight of technology in our portfolios. Nvidia is one of our biggest holdings, if not the biggest, in our growth strategy. And so we think that you still have to be overweight in tech and just take on a little bit of volatility if we see some disappointment here and there. But overall, we think over the next 6 months, 1 year, 18 months, technology is going to continue to be leadership.
Well, tech hasn't been the only thing doing well as of very recently. On Friday, after we had Powell, who very much so opened the door for a September rate cut, you saw small caps up 3.9%. We were just speaking with Keith Lerner of Truist, who also upgraded his view on small caps. Brooke, can you get the rest of the market broadening out alongside tech continuing to rally?
I wouldn't be surprised if we see a very short-term rally in small cap. However, we're still underweight. We think that, yes, lower rates will help small cap companies because they do have a lot of debt, and a lot of their debt is variable. So lower rates will clearly have an impact to earnings in a positive way. However, they're smaller companies. They don't have the ability and leverage to negotiate really hard with suppliers, and that's needed right now with higher input costs. In addition to that, capital expenditures have a little bit more of an impact with smaller companies. And if they need to upgrade their technology or implement more AI, it can be a little bit more of a burden to earnings. So we like large cap right now over small cap, and we'll probably continue to have an underweight there until we clearly see that we're going to have rate cuts materialize.
What's on your risk checklist here, Brooke? I mean, what would make you more defensive than wanting to buy dips?
The labor market. Everything is hinging on the labor market. When we look back over the last few years, a lot of strategists were calling for a recession, and it hasn't materialized because of the labor market. We've seen unemployment at 4% to 4.2% since May of 2024. And that's a really healthy labor market. Right now, the Fed's indicating that they think unemployment could go to 4.5% over the next year, which would be a tick up. And in the near term, as we see those 0.1 or 0.2% raise, it could lead to some volatility, but it isn't necessarily going to lead to a recession. In fact, if you listen to earnings calls, only 4% of earnings calls use the word recession. In addition to that, in the most recent CEO survey, 2/3 don't think that we'll see a recession over the next 12 months. So we think that really it's all data dependent, and we think that the labor market right now is the biggest risk.
Well, Brooke, speaking of earnings, you noted that 58% of companies increased their full year guidance, showing that maybe the impact of tariffs wasn't as severe as we thought. But we also heard from Walmart last week saying every single week the costs of products are going higher because of tariffs. For now, these companies keeping prices low, but at what point do they need to move into margin preservation mode and raise prices, or even do things like cut costs and let go of staff?
Yeah, it takes 2 to 3 months to see the actual ramifications of higher tariffs. So we are expecting lower earnings growth in Q3. And when you listen to what CEOs are telling us, how they're combating higher input costs, they're leveraging technology and utilizing AI to create some efficiencies. They're going to be aggressively negotiating with their suppliers, and they're trying to upskill their labor force. So we've got 7.4 million job openings. However, employers are expected to be very selective in who they hire. They need that greater productivity. And so we wouldn't be surprised if we're in a low to hire, low to fire environment where there are jobs available, but you have to have the skill set match to actually get hired.
Brooke, Forbes has rated you among the top female wealth managers, among the best wealth managers in the state for like the last 5 years in a row. How are your clients doing right now? I mean, obviously risk assets are at an all-time high no matter where you look, but uncertainty is up there as well. So are they spending? Are they buying properties? Are they buying real estate, or what are they doing?
They are. If you look at high net worth individuals, they're continuing to spend. And it's really the low income households who really have been hurt. It's interesting though, right now when we look at CPI and you look at the breakdown of what continues to be elevated versus what isn't. If you look at headline CPI, energy actually had a tick down over the last year. Food prices are flat over the last year, which doesn't mean it's not a little bit difficult at the cash register at the grocery store to pay that bill. However, we aren't continuing to see the increase. We just are still feeling the pain of inflation impacts over the last few years. However, shelter is the biggest component of CPI, and it makes up about 1/3 of CPI. And it continues to be elevated. I think the shelter component was up about 3.7% year over year. However, it's based on rents, an owner equivalent rent, not the price of your house. So those that were fortunate enough to buy a home and lock in a 3% mortgage rate and who don't plan to move aren't being impacted by that component. So high net worth individuals are feeling pretty good right now, and they're continuing to spend.
Well, we're going to get another read on inflation this Friday when we get PCE data at 8:30 a.m. Brooke, we're going to have to leave things there. Thank you so much for joining us. That is Evans May Wealth Managing Partner, Brooke May. Matt, let's take a look at some of the single names that are moving this hour. Palantir shares down another 2.6% after falling 10% last week. Now just trading at a paltry 206 times forward earnings. Poor Palantir.
Yeah, but still almost 100 times forward sales.
Crazy.
It's just unbelievable. Thoma Bravo is going to buy the call center software maker Verint, and we did see the shares jump in the pre-market. They're now down a 1.1% in the trade 40 minutes into the session because I guess the premium just wasn't as big as maybe it had been expected.
Yeah, it's trading under the premium. They're going to buy it for $20.50 a share. Also, I should just note, it feels like every day we are learning about a Thoma Bravo take private. So just another one for you.
And it always seems to be a software solutions provider.
Well, they buy software stuff, so that does make sense. By the way, I should say Thoma Bravo will be joining us next week here on this show, so stay with us for that. We have many questions. But we should also just mention, we saw on that screen crypto stocks like Coinbase are also down, but they just had a massive rally on Friday. So same like we're seeing elsewhere in this market, just taking profits.
Yeah, Bitcoin around 111,000. It had been at 125 a little over a week ago. Coming up, there's a lot riding on President Trump's first in-person meeting with South Korea's president. We'll have the details on that and the tariff results next. This is Bloomberg Open Interest. Let's get to high interest now. Look what's making headlines around the world. Ørsted shares are falling after President Trump's administration ordered a halt on construction to a nearly finished offshore wind farm off the coast of Rhode Island. The order comes 2 weeks after the company announced plans to raise nearly $9.5 billion in a share sale backed by the Danish government. It's the latest push by the president to halt the expansion of offshore wind farms, an energy source that he really, truly dislikes. The Pinot family is weighing options for Puma, including a sale of the German sports brand. The billionaire family has reached out to potential buyers, including Anta Sports Products and the Chinese sportswear company Li Ning. They have also sounded out other sportswear firms in the U.S. and sovereign wealth funds in the Middle East. Puma has lost more than half of its market value in the past year. And South Korean President Lee Jae-myung will meet with President Trump at the White House for the first time today. Lee secured a trade deal that resulted in the Trump administration slapping a 15% tariff on imports from South Korea. That was considered a good outcome for them. The summit will be the biggest, the Asian leaders, it will be the biggest test since taking office less than 3 months ago. And Danny, the president's been tweeting about it.
Yeah, he has. Tweeting this morning, what is going on in South Korea seems like a purge or revolution. We can't have that and do business there. Let's get more insight into what's happening ahead of that summit. For more, we're joined by Bloomberg's Washington correspondent, Tyler Kendall, who's outside the White House. Tyler, how do these comments from Trump cloud the meeting today?
Yeah, hey, Danny, not the greatest start ahead of this highly anticipated in the first face-to-face meeting between the two leaders after the South Korean president was elected back in June. And really interesting here to see President Trump allude to political instability in the country, saying that that would make it difficult for the U.S. to do business there. And of course, business and trade are going to be top of mind today. As Matt mentioned, South Korea was able to secure what's considered to be that more preferential rate of 15% tariffs on South Korean exports. But there are still a lot of big details and questions missing here when it comes to what that trade framework is actually going to look like. Though we did hear from the NEC director, Kevin Hassett, earlier today, who said that they are hoping to finalize some of those details during the talks. But perhaps one of the biggest questions is what that $350 billion investment pledge from South Korea is going to look like. And it's worth mentioning that we are expecting some private sector leaders to be at the White House today from South Korean companies, including Samsung and SK Hynix, as we try to get some more details here, because it's one of the big discrepancies between the U.S. and South Korea, with South Korean officials saying that this fund is going to be much more structured towards loan guarantees. I would also look out for another area where there seems to be some differences, which has to do with U.S. market access for U.S. agricultural products. This is a political flashpoint in South Korea, and one area where it does not seem that the two trading partners are aligned on. Matt and Danny, I would also just quickly add, it's not, of course, just all about the economy. It probably goes without saying that South Korea is such a top geopolitical ally, and we do have reporting from Bloomberg News that a top South Korean aide says that the president will push this White House to reopen talks when it comes to North Korea. And our analysts say that essentially they're expecting South Korea to try to use this backdrop of a renewed nuclear threat, the war in Russia, and also what has been heightened tensions between the U.S. and China amid trade talks to try to push the U.S. and South Korea closer together. I would say to watch out to see if we get any sort of commitment when it comes to South Korea boosting its defense spending, because we know that that is something that this White House is going to be looking for when it comes to the geopolitical dynamic.
What is, do we know what President Trump is referring to in his post? Because obviously South Korea did have a real period of instability, the martial law, the arrest of the president, kind of a revolving political leadership situation, snap elections. But that all happened before this trade agreement. So is there something new going on, or is he just referring to what's happened in general over the past year? What do we know?
At this point, it's exactly what you're outlining. It does appear that President Trump might be pointing to the circumstances that led up to the South Korean election in June, considering that this is the first face-to-face meeting between the two leaders. They had not met before, and we know that perhaps there is going to be in the backdrop here these trade negotiations, and perhaps the White House here is using a little bit of leverage, because I would point out that important part of that post where he does say that it could be difficult for the U.S. to do business. So I would really focus on perhaps the economic ties here in that through thread when it comes to President Trump's post this morning, and we know that those conversations are ongoing, Matt.
When we hear, Tyler, about investment plans, if Japan is going to spend $600 billion here, or if the EU is going to spend $750 billion, or if the Koreans are going to invest $350 billion, are any of those situations clear, or is every one of those situations confusing and filled with disagreement from both sides?
I think it's the latter, and that is one of the biggest discrepancies here when you hear the administration outline how this funding is going to be structured versus South Korean officials, for example, have said that this is really going to be more of loan guarantees when it comes to that $350 billion proposed investment fund. We will likely get some more details later on today, considering that we know some of these top South Korean companies in the private sector are going to be here. I will point out one point of clarity, though, when it does come to South Koreans' investment, which is that $150 billion is expected to go towards shipbuilding. We know that this was actually one of the biggest points of agreement when it came to the trade negotiations between the two countries, and the South Korean president, after he leaves Washington, is going to head up to Philadelphia to visit a shipyard there that is getting some of this investment. So that's one of the areas where we've actually seen some cooperation and both sides being on the same page when it comes to pledges.
Well, elsewhere there in D.C., Wednesday is the day that we are going to see 50% tariffs placed on India. And Tyler, our reporting suggests that they've hired a lobbying firm to try to get some better deal out of Washington, D.C. Before that, what does that tell us about the state of negotiations and a new tactic from the country?
Well, India is definitely hoping to try to lower these so-called secondary tariffs that are going to be imposed on August 27th. I would also point out that perhaps in a positive sign, we did see President Trump over the weekend announce the latest nomination for the U.S. ambassador to India. That position has been vacant since President Trump took office, and that could perhaps help to ease some of the tensions here, considering that we know that trade talks have really been stalled, and we haven't gotten any indication from this White House that they are going to back off that so-called secondary tariff threat. And we've actually seen India, for example, saying that it's going to continue to import Russian energy supplies. And we know that the discount on Russian oil helps India secure energy supplies for its growing population and contain its own domestic prices, which is really critical for growth. So, Danny, when you ask our analysts at Bloomberg Economics, they say that when New Delhi does that risk-reward calculation, there really is no guarantee that the U.S. would make any sort of trade concession if India were to halt its import of Russian energy supplies. So at this point for India, it's about maintaining its autonomy as well as the balancing of its geopolitical alliances. It's been quite the stunning reversal, though, Matt and Danny, when you think about it, considering that India had long been prioritized in these trade talks. We saw the country make concessions early, and often was our understanding earlier this year, slashing tariffs on a range of U.S. goods, for example. But one of those sticking points, again, very similar to what we're going to see play out with South Korea, does seem to be market access for U.S. agricultural products. We know that's something that the White House is pushing pretty firmly on.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there reporting live from the White House. Later this hour, we're going to discuss President Trump's executive order on alternative assets in 401ks with Eric Pan, the CEO of the investment company Institute. And of course, you can catch more political coverage on our political television show, Balance of Power. That's at 1 o'clock and 5 p.m. each day on Bloomberg Television. This is Open Interest. Take a look at these markets. We are looking at drops, but still hanging around all-time highs. So 64.53 on the S&P 500. The all-time high is 64.68. We had a massive run higher on Friday, and we're down now 0.2%. The Nasdaq really unchanged, and the 10-year yield at 428.87. We saw that yield come down drastically on Friday as well as investors bought that debt. They are now selling it off to some extent, but still pricing in an 80% chance of a rate cut in September. Coming up, the IPO market remains very robust in the Nasdaq. We'll speak with Jeff Thomas, the CRO. The IPO market is red hot at the Nasdaq. 142 companies listed on the exchange in the first half of this year, raising a total of $19.2 billion. And for some context, that's the most since 2021, which was like a weird standout year. For more on the IPO momentum, we're joined by Jeff Thomas, Nasdaq's Chief Revenue Officer and Global Head of Listings. And leaving aside 21, because that was just off the charts, right? This is incredible. And what's driving it?
So I think we measure something called the IPO Pulse Index at Nasdaq, where we correlate macroeconomic factors with internal Nasdaq data. And the index is now showing at an all-time high relative to everything except 2021. As we come through Q2, we saw a little bit of a pullback. There was some macro uncertainty. People weren't quite certain about it. But since we've gotten a little bit more regulatory clarity, feels like the Fed's going to be a little bit more accommodative. I think everybody is ready to start running. And then you just look at the performance of recent deals. And things have been doing really well, and that's always what leads to more deals.
I gotta say, Jeff, there does feel a little bit of an element of two step forwards, one step back, and the step back being companies that just don't want to be public or even take privates that are happening. There's one today from the Nasdaq variant that Thoma Bravo is taking private. As this happens, how big of a blow is it to the exchange to have companies, yes, IPOs are coming back, but a large swath that frankly don't want to be public or are public and would rather change to be private?
Yeah, I mean, there has been a macro trend over the last 10 years of companies staying private longer. And what's really driven that is the availability of capital in the private market ecosystem. And so we've been investing heavily at Nasdaq to create solutions to support not only the public markets, but also the private markets. But when we look ahead at which companies are coming to market, obviously there's a lot of excitement around technology companies. Anything to do around fintech and cryptocurrencies are really exciting. And we do start to see some private equity-backed companies looking to come to market this fall, because even if companies get taken private, a lot of these companies are big enough that the private equity sponsors are going to need to tap the public markets to create some liquidity.
I got to ask, one of the things that I guess I harp on this show is when companies leave money on the table. You must talk to bankers, right? When they're pricing Figma or Circle or CoreWeave, why don't they do a better job?
So I think, when I talk to the CFOs of companies that are going public, they are very mindful about the expectations they're setting with the investors that they're selling the shares to at their IPO. So at any given valuation, you're implying a certain set of growth and profitability expectations into the future. And I think that's one thing that people oftentimes, they worry about the money they're leaving on the table on day one. But for the CFO, it's really about what's the expectation they're setting with those new investors in terms of where their growth and profitability is going to get in the coming year.
But do you want to see 100% pop? Is that necessarily a good thing?
I think it's really hard to kind of handicap the markets right now because there's so much excitement around some of these deals, around some of the new issues. You have seen a couple of the companies with these big pops trading back. And what's interesting, as you look at the stock chart, you're always measured to that day one opening price as opposed to the IPO price, because it just doesn't show up.
That is true.
So even if you've pulled back a little bit, you may still be well up over the IPO price, which is really that commitment you made to those IPO buyers that, hey, here's where we think the company is fairly valued and here's the expectations we want to set.
Well, how much of this is also just about the fact that since April, volatility has been sapped from this market. If you see a reemergence of volatility, which means your first day of trading could be even more painful and even more sporadic, do you expect the pace of what we've seen of offerings to slow down?
I do. I think volatility is definitely one of those factors that we're looking at in that IPO pulse index. And like you said, that's way down. Valuations are way up. And I think now you're just really looking at things like investor sentiment and, again, the Fed funds rate. Once those things come a little bit more in line, I think we're going to continue to see a lot of excitement around the IPO market.
What's the quality of these IPOs? Because we mentioned 2021, and I think you had like 700 IPOs that year. But a lot of them are SPACs, right? And that seems to have died off. Now it's come back to some extent. I think you might have 40, 50 SPACs in your total this year.
Even more. So we've in the first half, we raised over $10 billion for SPACs. So we do think that that's a part of the going public process that's going to come back. We're not back at the levels that we saw back in 2021. But in general, what we see in terms of companies coming public today, the companies have larger revenue. More of them are profitable or have a good path to profitability. So I think investors are being much more rational. And the companies just are much more substantial. So even when you look at SPAC business combinations, of which we've had 30 already this year, the companies generally have a lot higher revenue and profitability than they did previously.
It's still one of those things, though, when SPACs are coming back, when the king of SPACs, Chamath Palihapitiya, puts one into the market, people love to say market top. Or when you see meme stock trading taking up 10% for one individual stock of all trading of an exchange, people worry about froth. How do you gauge the health of this equity market right now?
Yeah, I think when we kind of look at it, we're really focused on three aspects of the market. It's liquidity, transparency, and integrity. And we've been doing a lot of work with the new administration and the new SEC to say, what can we do to create a better environment to bring more companies to market? Because ultimately, the more companies that come to market, the more opportunities that everyday Americans have to invest in the U.S. stock market, participate in those gains. And that's really the other side of the topic we talked about before. As companies stay private longer, then there's just fewer of those opportunities for everyday Americans to participate in that growth. And so I'll say, you know, the administration has definitely put out a pro-growth agenda, and the new SEC is definitely leaning in and looking for ways to help us, you know, bring more of those companies to market.
By the way, meme stocks, did you see the UBS basket jumped more than 7% on Friday?
I guess cuts are good for memes.
Powell helped them out. That was the biggest jump, or hitting an all-time high. In terms of retail participation, in terms of lockup structures, what are you seeing now, or what's different about this market than 2021?
Yeah, I'd say in general, obviously like I said, a lot more companies have significant revenue and profitability. In terms of the sectors that we see really a lot of interest in right now, technology with a big focus on cybersecurity, fintech with a big focus on anything around crypto and blockchain. And again, we're starting to see a lot of these private equity sponsored back deals of significant size coming to market together. And I think those trends, a lot of those are areas that retail investors are interested in, especially in the crypto and fintech space.
Well, Jeff, I think it is a wonderful thing to get IPOs back, something exciting to talk about. Thank you so much for joining us. I'm sure we'll continue the conversation throughout the year. That is Jeff Thomas of the Nasdaq. Let's get a quick check on markets, Matt, because we are weaker so far, about an hour and some change into your trading day. Should just point out that at this level, we are 0.03% away from an all-time high.
Yeah, we're almost there, just about 11 points off of that all-time high. Let's get a look at some of the single stocks moving at this hour. American Eagle falling as Bank America downgrades the retailer to a sell because of tariff pressures. We were just talking about the fact that it's unlikely we're going to be making a lot of clothing, especially fast fashion in this country.
Well, maybe we will try to make furniture in this company. Furniture stocks like Wayfair, those are falling on Trump's plans to tariff imports. I should point out that companies that have more U.S. exposure are rallying today.
And Keurig Dr. Pepper is down as it buys JDE Peet, the coffee maker, for about $18 billion. That will create the second largest coffee company in the world behind Nestle, and those two will split apart, that one will split into two after it had combined.
Yeah, 7 years ago, the two of them combined. Let's get more on this deal. And on that point specifically, we're joined by Bloomberg senior M&A reporter Michelle Davis. Michelle, what about this is just the pressures of being a consumer company right now versus financial engineering making a comeback?
So as you were saying, this is really an undoing of the deal that they did in 2018 to combine Keurig, Dr. Pepper. And we've seen a big theme of simplification. You know, investors really want to invest in really streamlined companies. And so this is one of many deals that we've seen like this, where companies are undoing mergers that they did just several years ago. Other examples include Kraft exploring a potential separation. We saw Warner Brothers announce the same thing earlier this year. So it's really companies wanting to simplify because that's what investors are asking for.
I'm looking at, this morning, I'm looking a lot at coffee charts. I think KCA commodity is the generic coffee bean price, and it has hit an all-time high, or it's come back almost to an all-time high that it hit earlier this year. Isn't it dangerous to do a deal into this kind of price?
So what this is doing is allowing Keurig to separate its two businesses. The Dr. Pepper, Snapple, beverages part of it has been doing pretty well despite changing consumer tastes. But coffee, because of commodity prices, has not done so great. And I think what they're doing here is separating and freeing off that beverage company to kind of look like a healthier company. And the coffee company, too, as a streamlined, pure play company, will be able to, in their view, more effectively compete against like Nestle, because this is going to create the biggest pure play coffee company in the world.
Michelle, before you go, we'd also love to get your thoughts on a deal that the team has also been reporting on, and that's the Pinot family looking for options for their Puma holdings, which has been absolutely pummeled in public markets. It's not clear whether this would be a take private, but I wonder, given what we're just talking about with the Nasdaq CEO, yes, IPOs are coming, but how many of companies in pain are looking for different ownership options in this current environment?
I think the Puma story kind of dovetails into what we were talking about with Keurig, because it all kind of falls into changing consumer tastes. In consumer retail especially, consumers are so flighty, their preferences change so quickly, especially now in the Instagram, TikTok era, and what they're doing here is trying to reevaluate their portfolio holdings because of that.
All right, interesting stories there. Great work by the M&A team. Bloomberg's Michelle Davis writes on takeovers for us there on the other side of the building. By the way, Puma, I just realized they could get their old CEO back, Jochen Seitz, who's now left Harley Davidson.
There you go.
He was the one that made Puma again.
So like a Bob Iger, but for Puma kind of thing.
The Pinot family could call him back, and Harley.
Well, everything that's old is new, so they should just sell old Pumas, and they do wonderful with the old CEO coming back.
There you go. That's my advice, so go ahead and take it, Mr. Pinot. Coming up, investment company Institute CEO Eric Pan tells us how money managers are preparing for private assets in retirement accounts after an executive order. This is Bloomberg Open Interest.
Earlier this month, President Trump issued an executive order easing access for asset classes like private equity and crypto in retirement accounts. Let's discuss what it means for Wall Street with Eric Pan, the CEO of the investment company Institute. His firm's members manage $37 trillion invested in mutual funds, ETFs, and more. Eric, great to see you this morning. Thank you so much for joining. And look, when this executive order was signed, it brought with it a lot of excitement. But what does the process look like from here? At what point will we actually get some of these private assets and crypto into 401ks?
Well, it's great that the president has done the executive order, but there is a lot of work that still needs to be done. It's now in the hands of the Department of Labor, which is responsible for our retirement system, as well as the SEC.
So we're looking here at what we could see in 401ks, private equity, real estate, cryptocurrencies, other alternative assets. What is it that we can't still see? I mean, are ETFs still, are you still not able to buy and sell ETFs in your 401k?
I think right now there are a lot of limitations. So there are limitations on what ETFs can invest in. There are limitations on what regular mutual funds and collective investment trusts can do. So that's one piece, right? That's what we're looking to the SEC to do, is to lift some of those restrictions. They've been around for a long time. A lot of them were written at a time when the markets were very different. And then separately, it is how do we get it actually into 401k offerings? Right now, a lot of people, you go work for a company, you have someone who makes a decision as to what's available to you. So right there, the ERISA rules have to be changed to make it possible for people to get access to some of these investments.
Eric, with this and always in private assets and private capital, it seems like a fear always arises when you open it up to a retail audience, and that is that you would get funds who package up the worst of their products and dump it onto retail. Perhaps you don't need many people doing this, Eric, but one bad apple spoiling the bunch is certainly a fear that's present. How big of a risk is that?
Look, in financial markets, there's risk in general. There's always the possibility of bad investing. You invest in the stock market, which millions of Americans do every day. There are good investments and bad investments. The question is, are people going into these markets with their eyes closed or eyes open? In our retirement system, we have a number of people whose job it is. They're fiduciaries who need to look at what are quality investments. There are experts who examine what investments are actually doing. So I'm very confident that we have a system that's in place that will mitigate the risk of these so-called bad investments kind of ruining the party for everyone else.
So what about the liquidity issues? I mean, what or how would target date funds be able to incorporate these alts without affecting daily dealing, without affecting participant comprehension? How would that work out?
Well, so this is why the retirement system is actually a good place to start, because you're saving for retirement. So for people in their 20s and 30s, they've got a 30-year time horizon, maybe even longer. They've got a lot of time. And what they don't need is necessarily liquidity. What they need are long-term returns. Target date funds, which is a way for funds to reallocate the risk profile of a portfolio as you get closer to retirement, is a perfect case of where someone early in their journey obviously can take on more risk. Liquidity is less important. As they start approaching their 50s and 60s and they start looking closer to retirement, the portfolio would move them out of these less liquid investments into things that may be more appropriate for someone thinking about retiring quite soon.
You know, Eric, Matt mentioned ETFs, and I think there's an interesting corollary here. Of course, a lot of your members are mutual funds, and active mutual funds saw some serious fee compression in the industry once ETFs were introduced and retail could get access to them much cheaper, or even much cheaper than a hedge fund. Hedge funds also went through some fee compression, too. Is there a risk that the private capital industry goes through the same thing if you now have these products that are given to retail and presumably at lower fees, too?
Look, I don't see it as a risk as much as an opportunity. The fact is, we're in a very competitive market, right? And Americans deserve to get high-quality investments at a good price. And if through innovation, through competition, people start lowering their fees, I think that's only good for American investors. The story of mutual funds, ETFs, active ETFs, and then eventually what we're looking at the private markets, I see this as part of a long story in our financial markets. It's been true ever since the 1920s.
Let me ask you, Eric, finally, what's the TikTok of the lobbying efforts here? I mean, you mentioned that a lot still has to be done. I imagine you want to have a part of that planning and decision making. How do you affect that in Washington?
I think you've touched upon a very important point in this interview, which is there's a lot of information that's about these investments that people don't understand. There's a sense that there's a lot of risk, that there's danger. I think it's really important for the industry and our work here in Washington to take these concerns seriously and find ways of addressing them. Nobody here in Washington is saying these investments are just from the get-go ready for everybody. There's a lot of work we need to do with our regulators, with the Treasury Department, the White House, and we're very focused on that work. So I'm very optimistic because I work with a lot of the firms here in Washington, a lot of the other trade associations. We're all very serious about making this work in a way that American investors will benefit from this new innovation.
All right, Eric, thanks so much for joining us. ICI President and CEO Eric Pan talking to us about alternative assets in 401ks after the president's executive order. Speaking of President Trump, right now he is speaking at the White House. He's expected to sign a couple of executive orders today aiming to end cashless bail in Washington and nationwide, marking the latest move in the administration's agenda to crack down on crime. We'll continue to monitor his remarks, and you can monitor them as well on your Bloomberg terminals. Type LIVE GO. This is Bloomberg.
Media. But many of you are corrupt, and it's nothing we can do about it. But we keep winning, and we're going to keep winning. And this whole story on crime is incredible that the Democrats wouldn't be winning.
Let's take a look at what's ahead for the markets. Later today, South Korea's president meets President Trump at the White House, and surely you'll see something on that. Wednesday, the 50% U.S. tariff on imports from India is set to take effect, but the main event on that day comes after the bell with results from Nvidia. And then more retail earnings roll out throughout the week, including the Gap, Dollar General, and Best Buy, as we've been talking about on Friday. We wrap up the week with PCE data plus University of Michigan consumer sentiment.
Can any of those get in the way of a big roaring bull market? If you are a bear, you were bulldozed on Friday. There is a little bit of reprieve from the gains. I guess not reprieve from the gains, a break from the gains. You'd want gains to continue today. But it does feel like just that consolidation down about 0.2%. We're 0.03% away from all-time highs, Matt. But with Powell opening the door to September cut, it feels like the summer melt-up is just going to turn into an autumn melt-up.
Yeah, I'm really interested to see not what happens this week, but in the next month up to the Fed meeting on September 17th, because we'll have another look at the labor market, right, with the non-farm payrolls at the beginning of September, but we're also going to get more looks at CPI and PPI. Obviously, PCE comes at the end of this week, but prices seem to be on their way up, not on the way down. So if we get a strong a jobs number, then those bets on a Fed cut are going to be reduced drastically.
But Powell opened the door to September cut, and I just don't know how you close that without having big ruptures in the market. And this is a Fed that doesn't like those ruptures. And you know what will happen if that does? It gets the attention of the White House. And Powell's trying to avoid that.
Yeah, absolutely. Well, he can't avoid it. Coming up tomorrow, Moneta strategist Ethan Devitt joins us, plus David Dindy, the CEO of Atomic Invest, and Mark Rosen, the CEO of JCPenney, to talk more about retail. This is Bloomberg Open Interest.